Investing in an established company like McDonald's is very different than investing in a startup company that's very young, because McDonald's already has the market share. And they're making these big profits that they just give away to shareholders because they don't have a better use for that money. A startup, on the other hand, wants to take all their money and reinvest it because they want to grow as big as possible, as fast as possible. They haven't established themselves the way McDonald's has just yet, so they are gritty, they want to grow, and they're willing to take on more risk. This is where you have the ability to see more growth in your stock price. You buy a stock for $100 and it goes up to $200. But it also comes with a little bit more risk because it's not as established and it hasn't built itself yet, but you can also see more upside potential. Now, a lot of people on Wall Street are going to have their own definition of growth. But for the purposes of this video, when I talk about growth, I'm talking about investing in companies that are focusing on fast growth in their stock price. And I'm going to break it up by talking about three different things: tech companies, growth companies, and more niche companies. So let's go over a few ETFs. Again, I'm not telling you what to invest in. I'm just showing you a few examples to help you start thinking like an investor. There is an ETF called QQQ, which invests and gives you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest stocks that are not financial, which means most of the companies, not all, but most of the companies in the NASDAQ are tech related. So if you want to get exposure to tech, many people will say that QQQ is an ETF that can give you exposure to the broad tech area. And we know that in general, tech companies are generally focused on growth because they're always trying to innovate. But some of you might be thinking, well, Jaspreet, that's not exactly growth. What if I just want to invest in growth companies? Again, there are funds that specialize in giving you exposure to growth companies. For example, VUG. For example, IWF. VUG is an ETF created by Vanguard, which gives you exposure to growth stocks. And IWF is an ETF created by iShares, which also gives you exposure to growth stocks. What is a growth stock? Again, these are smaller companies that are focused more on the growth, that are not really working to make huge profits and pay out big dividends. They're focused on growing their share price. More risk, more potential return. Or we can get a little bit more niche and look for a specific industry that you believe is going to see a lot more growth and upside. Again, here are a few examples. VGT is an ETF created by Vanguard, which specializes in giving exposure to IT companies, IT stocks. So if you believe that the IT sector is going to explode, this is something that you may want to consider, or other ETFs related to it. QTUM is an ETF that gives you exposure to quantum computing. Quantum computing is believed to be the next technology after AI. It is an idea of creating chips that are infinitely times more powerful than the chips we have today. There are many companies that are innovating and investing in quantum, but quantum chips and quantum computing isn't readily accessible yet. If that's something you believe in for the future, this is something you may want to consider looking at. But again, we don't know where it's going to go. Higher risk, higher potential return. And then we have AIQ, which, if you couldn't guess from the name, is an ETF that gives you exposure to artificial intelligence. Again, there's been a huge run-up in artificial intelligence. Some people say it's a big bubble that's about to crash. Other people say it's just getting started. And so if you have a long-term mindset, you want to be an investor, and you believe that we're going to see a lot more growth, well, you have opportunities to invest into that niche through different types of ETFs. Again, my goal is not to tell you what to invest in. I want you to start thinking like an investor and see what the opportunities are. That way you can make the right decisions for you based off of what's right for you, your family, and your community. But we're just getting started. Now let's talk about investing internationally, because if you see a recession in the United States, well, that could hurt a lot of different assets in the United States. But you could protect yourself by also owning assets in other countries. Take a look. If the United States economy enters a recession and the stock market goes down and real estate prices go down, that would impact your investments in the United States. But sometimes you'll see a recession in the United States while other countries like, say, India are seeing a big boom with their economy. And this is where you can see some real diversification, where if you own assets in India or other countries, well, that could benefit you during a time of downturn in the United States, because we know recessions happen, we know market crashes happen. In the last 100 years, we've seen 16 recessions and 25 market crashes. They're going to continue happening. So one of the things that you can do to make sure you win in all types of asset cycles is invest your money in foreign countries as well. Now, you might be thinking, well, Jaspreet, that doesn't sound very easy. I don't know anybody in India. How do I go out and invest in India or Brazil or China or one of these foreign countries? Well, again, there are funds that can make this very easy. And we can talk about this from a broad perspective and a niche perspective. From a broad international perspective, VYMI is an ETF that I'm personally invested in as a disclaimer, but this is an ETF created by Vanguard that gives you exposure to international companies, but more specifically, high dividend paying international companies. So this is an ETF focused on dividends, cash flow, but not in the United States, internationally in non-United States companies. Then we have VEA. This is another ETF created by Vanguard, but this specializes in investing in developed foreign countries. So more of the established foreign countries around the United States. This invests in companies in those developed countries. But then we can compare that to IEMG. This invests in the emerging markets, the smaller countries. So you can start to see the differences. If you want to invest in a more smaller country where you can see more growth in the economy and more growth in those companies, higher risk, higher potential return, this and other emerging market ETFs could give you access to that. If you just want to invest in more of the developed foreign countries outside the United States, ETFs like VEA can give you access to that. And if you want to invest in cash flow outside of the United States, VYMI and other ETFs can give you exposure to that. Again, there are many ETFs out there that can give you exposure to each thing. I'm just getting your brain thinking like an investor. But you can also get more niche. For example, INDA is an ETF that gives you exposure to, do you want to guess? Indian companies in India. EWZ is an ETF that gives you exposure to companies in Brazil. So you don't have to go into Brazil or go to the Brazil stock market to invest in Brazilian companies. You can just invest in an ETF like EWZ. Again, there are many different types of countries you can invest in. There are many funds for them out there. You just got to find what's right for you. Now that we covered how you can diversify yourself outside of your own country's economy, let's talk about how you can have a different level of growth and diversification in speculative assets, which is very different than everything else we've talked about so far. A speculative asset is also risky. This is something that you believe will go up in value, but there's a chance that it could just completely burn and crash. But because of your belief that it might go up in value, you can consider allocating some of your portfolio to this. Now, my personal recommendation, which take it for what it's worth, I'm just a random guy on YouTube, I can't tell you what you to do, is that if you're just starting off, you should have 0 speculative assets. As you start to build your wealth, now maybe you can work your way up to 10% of your investments in speculative, and maybe as you start to really build more wealth, maybe 20% of your investment portfolio can be more of speculative assets, but I wouldn't do more than that. For me, my speculative assets make up no more than 18% of my investment portfolio, but take that for what it's worth. Here are a few examples of what I mean. Cryptocurrency is something that I consider a speculative asset, and I treat it like that in my investment portfolio. The startups that I invest in, I treat them like a speculative asset because I know that startups can go up in value very fast, but they can also go bankrupt just as fast, which has happened to me. Startups that I've invested in have gone bankrupt. Same with crypto. We've seen crypto booms and busts. So yes, it can go up, but it can also fall just as fast. A couple other examples are trading cards. I know a lot of people like to talk about trading cards as an investment and watches as an investment. These aren't things that I have personally dabbled into, but some people like to look at these as investments, and there's a whole lot of others, but this is all speculation. You're hoping that this thing will become more valuable. You're hoping that people will want more of this thing in the future, but there's no guarantee. It's high risk, high potential return, which is why I don't make it a big piece of my portfolio, and I don't like to see it as a big piece of other people's portfolios, especially as you're just starting off. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.